Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is Wednesday, October 25th. We have Joseph Wang and Ira Harris. Joseph is known as the Fed guy, having worked as a senior trader on the open markets desk for the Federal Reserve. The desk sits at the center of the dollar system as the ultimate and infinite provider of dollars. It has access to virtually all regulatory and financial data, as well as open lines of communication with all major market participants. One of the few places in the world where one can definitively learn how the system works. And prior to joining the desk, Joseph was a credit analyst, and in another life, he practiced law. And Ira is independent trader, hedge fund manager, and global macro consultant trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thank you, Richard. Thank you,
Richard.
Joseph.
Hey, you are. Great to be back.
Yes, good to see you. Very good. Always good to see you.
Great. I thought we'd begin with your macro view, Joseph, on the economy and the financial markets sort of in general.
Yeah, so I think a lot has happened since we last spoke. I recall last time we were talking about higher yields, and you made the note that you thought mortgage rates were going to go much higher, and that exactly happened. And you know where we are. I think that very few people a year or two ago would have expected that we could have the 10-year breach 5% a bit, have mortgage rates around 8%. So I think that's a pretty exciting place to be. So what I think is happening right now is, as many people have talked about, we just have tremendous imbalance between supply and demand. So we all know that the fiscal situation in the US is, as Chair Powell noted, not sustainable, but that everyone knows that. What really changed, I think, over the past couple of years is that the demand aspect is shifting. We had the major marginal buyers basically step out, that being the Fed and that being the commercial banks last year. And though they stepped out last year, there was actually a new player who came in to fill that gap. So you had the investment community. So a lot of the, let's say, pension funds or real money managers really increased their exposure to treasuries through the futures. And then you had hedge funds step in to buy cash treasuries and arbitrage that through the cash futures basis trade. So when I look at the data, it seems really clear that the cash futures basis trade basically exploded since the last Q4 of last year towards, let's say, the first quarter of this year by several $100 billion. And so when we had the commercial banks and the Fed step out, basically the investment community stepped in and became a big buyer in treasuries. And so, again, that bought us some time, but as we know, because the fiscal situation is unsustainable, that only buys time. The Treasury actually bought us more time in mid-June when they started to issue a lot more bills instead of coupons. And so that bought us a couple more quarters until basically last month when basically time seemed to be running out. And so we're at this point where there's basically somewhat of an air pocket between supply and demand, pushing yields higher. And that's actually having a lot of implications, both from my perspective of what the Fed will do and also the macro economy. So, over the past couple of years, Fed has been raising rates up to 5%, and it really hasn't done anything. If you look at GDP, it actually looks like it's accelerating. It's kind of funny. That's because nobody really borrows at overnight rates. What really matters is longer dated rates, like the 10-year yield. It's finally gone up a lot over the past month. And I think that tightens financial conditions meaningfully for the US and globally. And so I think that's going to be a meaningful headwind for the global economy going forward. But it also suggests that the Fed is probably done with the rate hike cycle and probably closer to cutting than the market is pricing, in my view. Now, we saw some Fed speakers come out and make that argument. Chair Powell himself seems to be open to the idea that, hey, financial conditions are being tightened by rising 10-year yields. So, we got to factor that in. Of course, he's not going to say that the rate hike cycle is over. If he does that, my gosh, he's going to undo a lot of tightening. But so far, I think that's where I think the Fed is. In my view, rate hike cycle is done, and maybe cuts are sooner than expected in the markets. Basically, the market is making the opposite error that they did for the past 2 years.
Yeah, very interesting observations and points. Your thoughts, Ira?
Well, there's nothing I disagree with what Joseph said, but I would just raise a couple issues. The Fed is to me, a very difficult situation here, because this year, let there be no question about it, they're going to be a drag on the fiscal problem themselves, because they're going to have a huge loss, because they're paying a lot more on interest on excess reserves than they are collecting on their portfolio. So that's going to result in a loss. But I don't think that'll be a problem for the Fed, because they'll just say, well, look, for the previous 10, 11, 12 years, we were paying the Treasury a lot of money. So we're just smoothing that out anyway. So where people try to gain some political edge on it, that's the way the Fed will answer it, because they have to take themselves out of that political situation. What they're going to do with the rates here, and Joseph's point, I mean, yeah, it ostensibly has had no effect on the data that we see. And I think that's really, because fiscal stimulus has just been so great, beyond really kind of what we've seen in a long, long time. But I think back to when, it's interesting when people talk about they always raise somebody who is the best of the day. So when the economy was really in a rut, everybody was parading around Olivier Blanchard's work on fiscal stimulus being far more important than monetary stimulus. And you've got a multiplier, I believe, in his work about 1.4. And you got it at a much more rapid pace. So that's what we're seeing. Now, when does this end? Because I think, although the fiscal stimulus is still playing out, and maybe we can get, I read that, and I keep reading it, that piece by Charles Calomares from the St. Louis Fed, when he wrote the piece on fiscal dominance. So maybe I can, Richard, we can get Joseph to talk about that whole issue of fiscal dominance, because I think it's critically important. The politics aren't there yet, but the CBO, which is notoriously, they're about as poor a forecaster as the dot plots, maybe a little bit better. But the CBO, which came up with numbers, well, we've far surpassed that. And to me, and others, we're in a very difficult political situation, because the interest on the debt is now greater than the defense spending. And this brings us to a place which I think is going to really play into the 2024 politics, because the budget issue is going to become a critical piece of the election. You wouldn't know it from the idiots running yet, but it will be in there. So if we can get Joseph to discuss a little bit about fiscal dominance, because I think more people need to be aware of it and its impact.
Yeah,
I think fiscal dominance is already here, and it's really going to fundamentally change how we invest, and how we invest going forward, because a lot of relationships are going to change because of it, and it also changes what monetary policy should be doing. But first, I'll make a note that about what you began with about the Fed having operating losses now. So basically, they basically have a negative interest income, and so they're not really giving money back to Treasury. And over the past 10 years before now, they actually earned Treasury about $1 trillion. So they definitely could have a loss to smooth out if they were to say that. But across the world, though, each central bank is a little bit different. Some other countries, their central banks, if they have operating losses, actually have to go to the legislator and ask for money. And so for them, it's going to be kind of an awkward conversation. So we are losing a lot of money. Can you please give us some more money? That's not going to happen for the Fed. Just some awkward Humphrey Hawkins testimonies, I guess. So when I think about the fiscal situation of the US, I think of it as this huge, huge cultural and political shift that happened over the past 2 decades. So I remember, let's say, growing up, we would have, at least one political party in the Congress talking about the importance of being fiscally prudent, having a balanced budget, and so forth. In fact, I think in the 1990s, we actually did have a fiscal surplus, and the discussion back then was, what should we do with it? And they decided to actually buy back some of the higher yielding treasury debt, just wanting to save the taxpayer some extra interest expense. We are so far away from that world. It's not even funny. So over the past, before 2019, I think the typical deficit was, let's say, $500 to $600 billion. And in 2020, that exploded around COVID. We thought that would go back to normal after the COVID spending, went away. But actually, it seems to have created a new paradigm where now the deficit is estimated by, based on current law, by the private sector and by government agencies to be between, let's say, $1.5 to $2 trillion a year, basically forever. And of course, I think the tendency over the past century is to continue to have new spending as time goes on. So this estimate that we see right now is very likely an underestimate. So the way that I look at this is that what's really special about the US government is that when they finance something, when they spend money, they finance it by printing treasury securities, which in the global financial system is basically a form of money. Like if I just gave you $1 million in treasury securities, it's not stuff that you can use to buy stuff at the grocery store, but it's an asset. It increases your purchasing power. And so in a sense, by having massive fiscal deficits, you're basically committing to massive helicopter money for the foreseeable future. And that, I think that is obviously inflationary. And that also makes it a difficult task for the monetary authorities, because as you are rightly noted, if you have a significant amount of debt, well, that's basically money that pays interest. And so when you're raising interest rates, thinking that it will slow the economy down, you're impacting the private sector, who actually is interest rate sensitive, but you're not really impacting the public sector, who doesn't really care. And so as you raise interest rates, you are actually making the deficit situation, this fiscal spending situation, even worse. And so you're putting us basically on track of this runaway train where we're just continuing to spend more and more, in part because of higher interest rates. There's a really interesting economics paper that looks at this problem. I think the paper is called Some Unpleasant Monetary Arithmetic by Sargent and Wallace 2 decades ago. And their interesting conclusion is that when you have a fiscal authority that is just going out of control, and you have a monetary authority that is inflation targeting, the strange conclusion is that what you should be doing is reducing interest rates, because when you reduce interest rates, you are in effect reducing fiscal spending, because there's less interest expense. I don't know if we'll ever go to that bizarre world, but that actually seems to be the right policy going forward. Now, I don't think we're there yet, but we are on an unsustainable trajectory. And so that's why interest rates are going higher, I think. And paradoxically, I think that's also quite bullish on stocks. Doesn't necessarily have to do with interest rates if you're thinking that we're going to have just enormous amounts of basically fiscal helicopter money going forward.
Mm-hmm. Interesting.
So if we go back to that point, the idea of cutting interest rates it's really part of what's his name, Warren Mosler too, with the modern monetary theory, right? That because in order to slow the inflation, MMT says, raise taxes, and an enlightened electorate will raise taxes. Well, that's where I've always broken. Whatever else MMT says, that I'm not stupid enough to accept. But something that has come up in this world, July 27th to be exact, when the ECB met, and they cut interest to zero of 1% of mandatory reserves. So they went, and when I read it in the release, I said, wow, this is kind of interesting. Why are they doing this? And I really felt that they were putting the Fed behind the eight ball, so to speak. And we haven't seen anything, and all it will save from the numbers that I've crunched and others. It will save the ECB $6 billion because they were paying what was going to be 4%. They're now paying 0 on 1% of 165 billion. But interestingly, our favorites, the Germans, Nagel, and maybe even Kausnat, and what's his name from the Holtzmann from the Bank of Austria, they're now talking about 10% will be zero interest on mandatory reserves. Now, to me, this is classic Bundesbank stuff because the Bundesbanks, before they surrendered to the ECB, were classic monetarists. So if they really want to tighten policy, they would move on reserves, which the Chinese seem to play in that world too, but they're always lowering the reserve requirements. So if the ECB, because Lagarde has a serious problem here, because she's, as you rightly said, it's just not the Fed. There's all these banks and they have different laws. And she's got a group of monetary hawks that she has to placate. You know, they don't tell you their vote, but, you know, let's be honest. The whole European Central Bank is built on the German credit card. And politics in Germany are shifting dramatically. Not the right is rising, and the AfD, which started out almost like a Tea Party type of, because it was totally based in economics, and they were opposed to everything that Draghi was doing, and the whole zero interest rate and flooding. But then they went on another track. But the German the German Constitutional Court will again have to rule on some of this stuff. But it is interesting that it is Nagel who's pushing on that 10%. Well, if they go to a 10% interest-free on mandatory reserves, now we're talking about really a big difference. And how is the Fed going to look at that? Because here the Fed is paying out massive amounts of money via interest on excess reserves or interest on reserves. And people forget that only came into being in 2008. This is a whole new realm and nobody has an answer for that. But Joseph, with your great experience, I mean, will the ECB, will their actions have an impact on what the Fed may be forced to do and we get an interest rate cut on excess reserves? Because I know the Fed presidents don't vote for that. It's only the governors. And we are looking at 4 Biden appointees who I think come from very dovish backgrounds because they're labor economists. Lisa Cook, certainly, and Philip Jefferson, and now we have the newest appointee. So there's 4. They could actually orchestrate a cut in reserves, or I don't think it matters anymore, the discount rate, because it's only the governors who can do that. So you should, between your law degree and your vast amount of experience, I look to you.
Well, you know, I think it's a really good point that you noted that change in how the ECB is treating interest on reserves. So the way that I think about that is I think about that in the context of, as we noted, central banks, you know, in a sense, you're kind of creating more money, right, by paying all this interest to banks, and maybe that's making the inflation problem worse. In the U.S., let's say we're giving 5% to banks, $3 trillion in reserves. That's $150 billion of free money to the banking sector. So, is that having an impact on inflation? I don't know, but you know, it sounds simulative to me, and it makes sense, I think, to just throttle that a little bit, not necessarily for economic reasons, but I think politically it's kind of a, you know, it's not a good image to be basically subsidizing the banking sector to this extent. And you can definitely design a system I think usually this is not just something that the ECB does, but other central banks like the Bank of Japan do something similar, where they tier their reserves, whereas some portion of it gets some remuneration, some portion of it gets other remuneration. It's an attempt to kind of balance this, as well as the need for having this interest on reserves as a way to implement monetary policy. So you can definitely do some design mechanism there. I think in the US, though, I think right now, I haven't heard people talking about it, but it does make sense. But one thing, though, that would mitigate against this, I think, is that right now we are thinking about significantly raising the capital requirements for the commercial banks. Mm-hmm. And of course, we had some bit of an accident in some parts of the banking sector in March earlier this year. So one way giving banks a lot of interest income helps is that it helps them recapitalize themselves. It helps boost their capital. And so maybe they might like that as well. Okay. And another thing is that when you're narrowly looking at just the interest income that banks receive through higher interest rates, I think when you're looking at just the vast swath of government liabilities, let's say, that's not that big a portion of it. The bigger portion in the U.S. is the Treasury debt, and that is much more than what the Japan reserves. Going forward, too, I think that so the Fed continues to do quantitative tightening. We're looking at maybe $800 billion. So the maximum is like 900 something, but we're not going to get that much. So, a sizable shrinkage of the amount of reserves in the system going forward. And that's going to save a bit on the interest expense too, that's going to be paid on that. So I don't think anything's going to be done right away. But it is something that they should be thinking about. It is a lot of free money that, I'm not sure we need that.
But Richard, if I could just add one last point, I know but we've run into people like Liz Warren and Sherrod Brown, who are certainly antagonistic on this issue. They bring it up and then it kind of falls to the wayside. But 2024 is here, and we are right in the middle of the politics of this. So I would just advise you got to be attentive to it, because there is going to be a lot of discussion about how much we're subsidizing the banks. We're going to subsidize them either way. This is a quieter way than if you have to redesign a new bank bailout like we did back in March. So it's just something. But I'm glad. I love having your opinion on it, because
they're definitely being pretty tough on the banks. So there's these new set of regulations called the Basel Endgame. And when you look into it, it's going to significantly raise the capital costs for banks. What it does is it applies a more stringent standard to the bigger banks, and it also broadens the coverage of it to also include the big regional banks. So basically anyone above, I believe, $100 billion. And if you actually, so I was watching the Humphrey Hawkins testimony, and basically every other question was a senator asking about this, and you could be pretty clear for most of these senators had no idea what they're reading. They're reading off a piece of paper. Basically, the banking lobbyists gave them something and that they're reading. And so there's kind of a full court press on this, because it's going to make the banks, I think, a lot less profitable, because they're going to have to raise more capital, and capital is expensive. So they are, I guess, Senator Warren and other people who are not best friends with the banks are going to be able to, I think, have an impact, if not by adjusting IOR going forward, at least through these regulations. And they're going to have big market impacts as well. So one of the things that's interesting about these set of regulations is that they meaningfully increase the cost of having a market-oriented business. And so after 2008, we saw liquidity across markets deteriorate significantly. And that's in part because of the Basel III regulations, like the leverage ratio. Upping it up a notch is going to make things worse. And I think we all hear that, in many markets, liquidity is already not very good.
Just a question on the repo market. If we look at the overnight reverse repurchase agreement level, it continues to decrease, it looks like, dramatically. looking ominously over the next several weeks if it continues. Any thoughts on that? And could that pose, problems in the plumbing of the financial system?
So what's been happening is that, over the past, let's say 3 months or 4 months, since the debt ceiling suspension in June, the U.S. Treasury has issued almost $1 trillion worth of net issuance in bills. And what that's done is that it's caused bill yields to cheapen a bit above the reverse repo facility offering rate. And what that is doing is it's attracting money out of the reverse repo facility and into the bill market. And so you can see money funds taking money out. I think we're down to, I think the decline has been about 800 billion in the past few months out of the reverse repo facility and into treasury bills. So that's actually a positive development, I think, for the financial system, because what happens is that money then goes into the U.S. Treasury's checking account and then gets spent into the banking system. So in a sense, it's a way to ease the funding concerns of the commercial banking sector. What's interesting, though, is that it actually hasn't been spent down yet. The U.S. Treasury seems to just be, having a huge checking account right now. So I think the U.S. Treasury has a checking account size of about 850 billion. So as it spends that down in the coming months, that's going to go and increase liquidity in the banking sector, but it's not doing that just yet. I'm actually a bit puzzled by why they have so much cash in their checking account. I suspect it has to do with geopolitical developments. What I saw in March, what I saw in 2020 was that the U.S. Treasury, in anticipation of fiscal spending to help associated with the pandemic, significantly raises cash balances, thinking that anytime Congress is going to do something, and so we got to have the cash on hand to spend this. Now, right now, what I'm hearing from President Biden is that he wants to do a big spending package to help Ukraine and Israel in the war. And so I think the U.S. Treasury is preparing for that. And so once we have Congress go and pass some legislation in the coming weeks, that will be spent out. And so that money will go back to the banking sector.
Mm-hmm. That's great points. Yeah, interesting. Your thoughts, Ira?
No, I did catch a piece last week that reserves at the Fed actually shot up a bit, and I was wondering, and it went out actually above a certain level that it hadn't seen in a while. And my first thought was, well, maybe they're parking more money. First of all, because of what are they earning on the reserves? 5.4%, and they're being forced to pay. We're probably up to 5%. So the banks are taking the safety of putting the money at the Fed. They're earning a little bit more. Their net interest margins are getting crushed. We know that. What I found interesting was when Chase, which is probably the best bank by a lot of standards in the country, went out of their way to announce that they were going to, for any CD of 5 million or more, they were going to pay 6%. You didn't see that?
That's a really good deal.
Oh yeah, if you had 5 million or more, because David Tepper responded to it. I didn't hear much more about it, but they came out and said that. And I said, wow, if Chase is doing this, these other banks are really being put in, and Chase may have done it for that reason, because whoever there's going to play to is going to be minimus anyway. But I said, wow, that's quite a shot to fire across the bow of your competitors. So I love this discussion because so many people just look beyond it. This is where, and Joseph is so good with this, with the plumbing. This is where it is, and this is what we're going to see. But I've got the bank stocks on my screen, and the bank stocks look terrible. Even JP Morgan is under $140, and the regionals are really suffering. Now, I know a lot of that is just because their net interest margins are being crushed, because more than anything else. And I'm wondering, is the system going to be set up for another run? I don't think so, because I think the run that took place in March, I think there were people who knew there were vulnerabilities and created the run. And I think that they've been told, be a little more cautious here because you're going to get a visit from the Department of Justice. I don't know that, but I'm just watching what goes on because the market is set up for another run in a minute if you really wanted to orchestrate it, especially in the electronic world. So I think people have been told, not so quick, not so quick. Don't, because you can start it by, first of all, buying a lot of puts or selling or getting short the common equity, and then putting out stories that such and such a bank is bleeding deposits. And then it created a negative feedback loop. And I think some people were told, hey, no. I think there were some Wall Street firms who made a lot of money being short certain banks at that time. I mean, we saw First Republic, which was a darling of people. Everybody loved First Republic. Everybody, going back to 07, 08, all they did was grow themselves. They did really well through the first leg of the great financial crisis. And then the bank just basically disappeared. So,
to your point, Yura, I was hearing that, back in March, basically a lot of the depositors were all part of this WhatsApp group or something like that because they were all part of the VC community and they were all texting each other, Silicon Valley Bank is not going to make it, we got to get our money out. And that kind of almost like a coordinated run, really. So,
yeah, that was my point. And you got I want to know who was getting short the stock because it doesn't just happen like that. So you can be pulling your deposits, but somebody is buying puts and creating synthetic shorts against the bank, which fuels it. And that's why I always wondered, did the word come down? Yeah, you didn't do anything illegal, but we advise not going that route. So, I mean, again, where do we find it? We find it in the reverse repo market. It's there. It's there for the asking. Sorry, Richard. That's
good discussion. Just wanted to go back about a month or so ago. Joseph, you wrote an article on potential for a liquidity event. Can you relate some of the thought and consideration behind that article, and do you still see that potential?
Yes, I do. And it just has to do with the structure of the market. So I think one of the big differences in the structure of the market today compared to pre-financial crisis, pre-2008, is just that there's a lot more regulation. And so because of that, like we discussed earlier, the banks are not as elastic in their willingness to make markets, to provide financing. And so you can definitely have situations where the market gets overwhelmed by the amount of selling. And so it just kind of breaks. And we already saw that happen in March 2020. The thing is, nothing since then has been fixed. And it looks like they're actually going the opposite direction by introducing the Basel III endgames, making, of course, it even more expensive for banks to be making markets, encouraging them to have smaller presences. And thus, the next time there's a reach for cash or anything like that, the market could easily be overwhelmed and we could have a big liquidity event where there's really nothing fundamentally wrong. It's just that you go in and sell and there's no buyers, because what usually happens if you're selling is that a dealer, like a bank dealer, goes and takes the other side and holds that, provides liquidity and holds that security until they can sell it to someone else. But because of the regulations, their capacity to warehouse that selling is just a lot smaller than it was, even compared to 2008 levels. And at the same time, the markets, just all markets, from treasuries to corporate debt to agency MBS has gotten bigger. So you have this big mismatch there where the warehousing capacity of the dealers has not kept in pace with the overall size of the financial markets. So it's definitely an accident waiting to happen. But again, you can't really bet on that all the time. It's just a vulnerability that you have to keep in mind.
You see that potential, Ira, in terms of those scenarios, maybe creating a liquidity event?
Well, I'm not nearly as steeped in this as Joseph is, but when it comes to Basel III, and it's been a problem, I think even under Basel II, when sovereign debt carries a zero risk weighting, in the banking system.
Right.
I think it makes for the liquidity crisis that Joseph talks about, because if you don't have to reserve against sovereign debt, and we've seen it in Europe, when Greek, it broke Man Financial, when Greek debt, and zero weighting wasn't even in shape, but when you carry a lot of sovereign debt on your books, and if you ask me, within the European banking system, the ECB, this is certainly a great problem, because they represent 20 different nations. And don't tell me that the Italian debt is nearly as good as the German debt. It's not. I can look at my screen right now and tell you no. And the Italian levels are only that high because the Germans are basically forced to stand behind it by the rules of the European Union. So I think Joseph's point is really, really interesting and right on target as a matter. But I always look at, and we saw that, sovereign debt, because yes, it's sovereign debt. We know, quote unquote, sovereigns don't default, although history says that's nonsense. We can go back to Philip II of Spain. We can go back wherever you want to go. But it is very dangerous that sovereign debt carries a zero risk weighting, because not all sovereign debt is the same. In fact, probably there are, what do we call it now? The Global South. There are Global South countries that carry a much better, whose entire profile as far as debt and the ability to pay it is far better than some of the developed world. You may have to actually haircut against it, but I don't know. I think Joseph's point is very, very important.
Just to follow up, the thing is, you are totally right. I mean, look at some of the people buying, let's say, third-year treasury bonds. They're probably down 50%, right? That's not risk-free at all. That's like equity-like returns, right?
Right.
But the thing is, government makes the rules, and they're telling the banks, "Hey, I'm a good credit, so you got to buy my stuff." Let me actually just describe a little bit about the liquidity structure that I talked about. So if you are someone who has to sell a treasury security or a corporate bond or something like that, what you do is you have to call up a dealer and sell it to the dealer. And the dealer will give you a price and buy it from you. And so the way that you get cash from your debt, from your bonds, is by selling it to a dealer. And what the dealer does is that he buys that security and then holds it until he can find someone else who's willing to buy it. So in a sense, he's providing warehousing capacity. He holds it for a while and then passes on to someone else. So if you look, so just looking narrowly at the treasury market, so just using that as a capacity, the dealer balance sheet sizes today are basically, about where they were, let's say 20 years ago. Well, not 20 years ago, around the great financial crises. But at the same time, the financial markets themselves have grown significantly. The reason why dealer balance sheets don't really grow in proportion is because the new regulations make it a lot more expensive for them to warehouse securities. So that means that if by any chance this much larger market wants to, let's say, sell their securities and raise cash, that warehousing capacity hasn't grown in proportion. And so you could have a place where you hit an air pocket where everyone sells, but the dealers can't buy it from you because they're at their limit. They're not able to warehouse any more securities. So that's where the potential accident happens. And that happened already in 2020. It's just that nothing has really been done about it. But I also want to note about the sovereign debt stuff. I think that it really does make a lot more sense for banks who are highly regulated to hold more capital against the sovereigns, because, like Yara rightly mentioned, those securities, they carry some risk, and part of the reason why, let's say, a bank like Silicon Valley went bust was because they didn't have to hold as much capital as required against the big losses on their quote unquote safe securities. I think there's going to be new regulations going forward that make sure that if you have these unrealized losses on your balance sheet, even though they're from safe securities. You're going to have to hold capital against it. So they're trying to do something about it, but it's going to come in the coming years.
And we referenced the global south in terms of the sovereign bond markets of the indebted Western world, like the Five Eyes countries in Western Europe. Is there selling by the global south countries? Do you see the statistics on that? What are your thoughts on the trends there?
What do you mean by selling by the other countries? Selling of what?
Yeah, sovereign bonds, treasury bonds of the U.S., Canada, Western Europe, if there's selling that is being seen or indicated in the statistics by global south countries, just looking at it from a geopolitical perspective.
Oh yeah, that's a good question. Are people moving away from the US because they're scared that the US is, let's say, might confiscate their money like they confiscated the reserves of the Russian government? I don't see that just yet. I'll make two notes about this. One is that if you look at overall foreign official sector holdings of U.S. Treasuries, the level actually hasn't changed for the past 10 years. So if you go back, let's say, pre-Great Financial Crises, these foreign official sectors, foreign central banks, governments, were big buyers of Treasury securities, but they really haven't increased their holdings, and they're not really big participants today. The second point that I would make is that it's not always easy to find out what foreign governments hold as their reserves. In China's case, for example, of course, huge reserves. The composition of that is basically a state secret. So we can kind of glimpse that a little bit indirectly through statistics on our side, but it's imperfect. There's someone called Brad Setzler who is an expert on this, and he's actually done a deep dive. And by his work, he actually thinks that, well, the dollar holdings of a country like China is not just not really declining, but is actually vastly understated because a lot of their stuff is confidential. And what they seem to be doing is, instead of just taking their dollar reserves and buying treasury securities, they're going out and they're making loans, let's say in their Belt and Road Initiative, to countries in Africa. So it's still in dollars, it's just not in treasuries, and it's large and not really observable. So it doesn't seem like the de-dollarization story has had real impacts that I can see in the data just yet. But definitely the trajectory in all the politics seem to be moving in that way.
Yeah, good observations. Yeah, your thoughts, Ira? I think you wanted to.
No, I know.
Yeah.
I lock up with Brad Sester. I know he's done that work for Foreign Affairs, for Council on Foreign Relations, and before him was Ben Steele. And if you relied on Ben Steele's analysis, we'd all be broke by now. But that's just my opinion. Brad's he's far better than Ben Steele is. Just my opinion. But I think every point that Joseph made is dead right on, and we know where this emanates from, because and I count him as a friend, Zoltan Pozar, who poses, no pun intended. And is it taking place? Maybe. This whole concept of central bank digital coins, we don't know what's going to come with it. We don't know how this is going to be done. But from a trading standpoint, there are certain things that do point that the world is definitely shifting. Nothing more than gold. And we just talked about that, because gold has no business being up at these levels. And I'm not one who ever believes that geopolitical events are a driver of gold. I think gold is inherently, it does on any trading day, but gold's ability to see off negative real yields, and that's where we're at. And
the strong dollar too.
And the strong dollar too. Yes, thank you. Really good point. Catches my eye, because I looked at it. I go, with everything that's going on with the central banks, and I mean all the central banks, I would have been much more comfortable seeing gold at 1580. I have some very important technical areas down there to 1620. we haven't gotten close. And that, you just have to pay attention to it. Now, gold may break $400. We saw a pretty good break after, of course, the rollover in the futures market in late July, early. We had $130, $40 break, which made perfect sense because people became to realize what the cost of carry of gold was. You know, because when you play in the futures market, especially, the markets are so efficient. What you pay as the premium is in essence the cost of carrying money, gold, if you had borrowed to buy that much gold. And when people say, oh my God, and then you realize it. But it sustains itself. Now, it's sustaining itself right now, maybe more on geopolitical factors, but gold was starting to move, well, before the start of the Gaza war. And Ukraine never did anything with it. So somebody is definitely acquiring gold. Who that is, I don't know. But it fits that narrative if you think that people are moving out of dollars. And that's why I bring it up, because they're going somewhere. Even if you're buying 5%, if you're moving 5 to 10% of your assets out of the huge dollar positions that you held, it's still a size, you know, that's a lot of gold or whatever it is that you're going to buy. And again, we have to come back to Europe, because the ECB is in a difficult situation here too. Maybe more difficult than, probably more difficult than the Fed. And to me, Lagarde was brought in for her political acumen and her ability to maneuver in the European political morass more than her central banking ability. And I think she's actually done a pretty good job with that. I thought it was a terrible appointing, but when you really think about it, her political acumen is really, really pretty good. And she's balancing, but she's got those 5 hawks, 6 hawks, 7 hawks who she has to placate, because just like in Animal Farm, they're all equal, except some are more equal than others. And if you're the Germans and you are really underwriting the entire project, I don't care what the laws say. We know that the credit rating of the ECB is only as good as it is because it's the German, the Dutch, the Austrians, the French to a certain degree, although France is up and down in the way you see it. But they are inherently indemnifying that system against a lot of uncertainty. And that's a difficult thing. So that may be prompting gold too. And we look at gold yen is at all-time highs. Gold in terms of Australian dollars, gold in terms of Chinese yuan. So gold has done, if you look at it only in dollars, you're missing a lot of the picture. So, you know,
I think you make a really good point in that the gold market, you know, it's a relatively small market. You just have to have like all these people who have huge amounts of dollar reserves or other country reserves move a little bit in, and that's potentially quite explosive.
Yeah. And I think you've seen, nobody's going to tell you. It's not like, you know, one of the worst things I've seen was Ackman, who talked about, you know, a 5% handle on the 10-year and months ago. But I think Joseph and I talked about it. You know, we talked about rates going higher. And then he announces, well, so then he gets a platform on CNBC to say, well, I don't think the short. Meanwhile, he covered all the shorts last week. So, you know, yeah, more power to you. If the market's going to grant you that much influence, okay, we just live with it. But I find it, you know, very interesting to say the least. But that's the world in which we live in. Just like everything we see now is driven by algos. Everything. And then people say, well, what are the algos do? The algos are programmed to read words. They're key worded. I saw it the other morning when they released 2 hostages. I happened to be working out. I'm in the gym, and I knew something big happened. I hadn't seen the story, but of course, release of hostages are the key words, and it sent the market reversing all its previous actions for about an hour or two. But it does have its impact.
Wow. And just a final question, if that's okay, Joseph, on will you see interest rates along the yield curve trending in the US and even elsewhere, what your thoughts are on trends for YCC, yield curve control, Bank of Japan, Federal Reserve?
I think given our fiscal situation, yield curve control is inevitable in my view. Right now we have huge supply and we already see interest rates pushing up pretty aggressively. Now, I don't think the market is really elastic. And so when you have a lot of supply, you don't really have someone who can just step in and buy unless you're the Fed. One thing that I'll note is that I think before we get there, though, the Fed is still wants to be an independent institution, still wants to do a good job. So they're not going to subsidize the Treasury, subsidize all this enormous bad fiscal spending. So I think what will happen first is that the U.S. Treasury will actually try to step in and, of course, being a political entity, try to do something about this. And I think they already are. For example, now the U.S. Treasury operates under guidelines they set themselves. So they want to have bill issuance be between 50 to 20% of total marketable debt outstanding. Last quarter, they said, we have to finance a lot of debt, but I don't want to issue a ton of coupons, so I'm going to issue a little bit more bills. Going forward, I think my share of bills will be 22% for some time. So I perceive that to be that's them kind of tipping the scales a bit. So issuing a bit more short-dated paper, which can be more readily absorbed rather than coupons, which would push yields higher. So I think there's still a lot of room for them to continue to do that. And so that will give the longer-dated yields some breathing space. It's only temporary, of course, but I think that buys us more time. Ultimately, in the medium term, I think yield curve control is inevitable in the US. Other countries probably as well. I just don't study them as closely. What do you think, Yara?
Well, I think that's a really good point, and that has to be their fallback position at some point.
Yeah.
And Joseph, as long as we're on this, I was going to ask you, I have it written down because this thing's come to my mind. So all last week, every Fed speaker talked about how the market was doing their work, right? Which is giving them a basis to pause. And I go, this is kind of interesting. This is a group who has done their best to me to undermine the signaling mechanism that markets are good at. Hence we've had all the discussion about the bond vigilantes returning, but the Fed has done, and I'll go back to 2013 when you were probably at the Fed, when we had the May-June taper tantrum, and Bernanke cowered in the face of what the market was telling him, where I believe that had he stayed the course and let the markets work it out, losses would have been sustained, but we would have been in a far better situation. That was my view in real time, and looking at hindsight, it's even more so. But now we got, last week, everybody, Waller, they all talked about the market doing the Fed's work because they were pushing up the long end of the curve. And I found that fascinating. And I go, why is this conversation taking place? And I go, and even Powell on Thursday at the New York Economic Club talked about the market too. I said, to me, when I read Powell, he seeks unanimity on the vote. Every meeting vote. He wants it to be unanimous. We don't have Tom Hainig there. We don't, even Esther George, but he wants a unanimous vote, which is why we get, to me, hawkish pauses and dovish raises, because he's trying to placate everybody. Well, I think, going back to what we discussed earlier, this is just an opinion. I certainly don't know anything, but he's got some concerns about what I would call the Biden appointees breaking. And if he can say openly, well, the market's doing the work, nobody can complain because we're not controlling this. It's the market doing it, and we don't need to raise Fed funds. Again, the market is doing this. So all going to this, I see this all together here. And I think you're right. When you talk about a pause and maybe a cut, it's because the market is doing it. And if we go to yield curve control, they'll set a price on it. And again, what is the Treasury going to do, coming back to your point? Do they keep pouring treasury T-bills into the market? Or do they extend and offer more coupon-oriented debt? Now, I will applaud the Chicago Mercantile Exchange because they, in the last 3 months, brought back the T-bill futures contract. Did you see that?
Yeah, I saw that. That was really interesting.
Yeah, I'm actually trading it. I put in orders. I don't always get filled, but it's an interesting because now there's so much in T-bills that the ability to hedge or basically just speculate them is pretty good. Here, I'm going to give.
How's that market trading?
I'm going to give you the numbers right now. Oops, hold on. I got to go. It's in front of me. Let me go to get a live quote. Right now, it's at 94.66.5, which is what, a 5.33, which is probably right. This is on the March. I'm looking at March of. So it's basically a 6-month bill. There were just 900 on the bid, and there's 200 on the offer, a tick apart. So it's not bad. It's building. There's people making markets, but I think as more speculative traders, really realize it, unfortunately, it doesn't, because we have SOFR now instead of the euro dollars, we can't synthetically create the TED spread as we used to love. So when there was a bank run, to be able to create the TED spread was some of my greatest trades in the late 70s and 80s. Continental Bank, I got even with them for not hiring me because I caught the TED spread on the day they went under. So and I had to take myself away. I said, I'm going to play golf because if I sit here, I'm going to unwind this position well before. So it does bring another instrument to play. And my hat's off to the CME. And I own a seat, in full disclosure. I own a few seats still, and I sat on the board. But I think this took a lot of wisdom to recognize the potential shift in all the funding markets. But I love your point on YCC. I think it's dead right on target. When and how, don't know. But we're going back to basically 46 to 51 with the famous Accord. And that's where it'll put us. But there's just so much debt out there right now. They've got themselves in a very tough situation. We'll see how that plays out.
I agree. And also, just on your point, the TED spread, I mean, how are we going to figure out if there's funding stress now, right? There's no LIBOR. It's like they broke the mirror, so we never know anything's wrong.
Yeah. Yes. So yes, I know it was such a great indicator, but because SOFR really has no bank risk to it, right? It's removed that element, and that was such a good signaling mechanism. So you know what, Joseph, I think that's a great question. It forces me to watch the bank stocks now more than I ever watched them, and I don't ETFs. Because I want to watch the individual stocks, because there's certain ones to me, like JP Morgan. Why is JP Morgan all of a sudden under pressure? I was having a little chat yesterday with one of my favorite people, Chris Whalen. We were just online chatting a little bit. And I noticed, and we was talking about it, Synovus Bank, which is a large regional that I happen to know well, down in Southeast, in between Florida and Georgia, and they're a fairly large regional, in an area of the country that's doing so well, but yet the stock is making new lows from the lows it made in May after the debacle of March and April. So by watching those stocks, I can't watch the TED spread, but I can watch the bank stocks, and it's forced me to do that a lot more.
That's a good point.
Great, insightful discussion, and just wanted to ask Joseph, how can our listeners and viewers learn more about your work?
Well, thanks so much for having me. If you're interested, I publish weekly blog posts on my site, fedguy.com, and also weekly videos on what I think is happening in the markets on my YouTube channel called Joseph Wang.
Yep. Great. And Ira?
And I go to them all the time, because intelligent people cite them. I can't go to Twitter. It may make its way there, but I'll be somewhere and someone will say, "Oh, did you see the Fed guy?" So, yeah. And that's, if it comes from somebody I respect, I go, "Oh, I got to get there," because you can get inundated, but there are certain people who are must watch. And in fact, I have numerous people who call. I said I'm going to be on with Joseph Wang. I can't wait for it, because they want to flush you out and hear what you have to say, because the plumbing is so important. So
thanks so much for your kind words.
No, hey, as they tell you, if you say the truth, if you say the truth, you don't have to remember what you said, right? So that's just the way it is.
And Yara, I enjoy your blog, but you got to keep posting. I haven't been reading it for some time.
Yeah, you know what? I've been traveling a lot, and had some stuff that I had to take care of. But in fact, I was going to blog on Sunday, but what did I get? I started watching baseball, so it took me away from it. Okay, I am going to get on it, but
thank you so much. Yeah.
But I love doing these. Thank you, Joseph.
Thank you so much, Joseph.
See you guys again. See you guys
Thanks,
later.
Richard.
Take care.
Thank you.
Bye.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.